Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 10th of December. I'm Daniel Lam, your host for the podcast. Ahead of FOMC, I want to discuss a bit about the shift in correlation between the US dollar and US equities, which has been a main theme of 2025. Correlations. It matters a lot for allocation, diversification, and hedging. And very often, shifting correlation means regime change. And this year, the thoughts of de-dollarization and US unexceptionalism have been very much on investors' minds. The most striking change came earlier this year when the US dollar decoupled from interest rate differentials after Liberation Day. While the relationship has partially recovered, the US dollar and rate spreads remain far less correlated versus the start of 2025. Now, the co-movement of the dollar with US equities is also attracting attention. So the inverse relationship turned positive during the post-Liberation Day Sell America trade, when both the dollar and the S&P 500 fell in tandem. The DXY S&P 500 correlation remains elevated despite the normalizing market backdrop. So the ultimate test of the past inverse correlation would be, will the US dollar attract safe haven flows in the next bout of equity stress, or has the relationship changed permanently? Well, from the strategic perspective, the US dollar equity correlation is likely to remain positive because the rest of the world seeks to diversify away from the US, especially from the US dollar. And this has telling implications on the various macro scenarios in the US. So in our base case, which is soft landing, we're expecting mild downside for the US dollar. In the case of no landing, there could be amplified upside to the US assets. The dollar would be rebounding significantly, perhaps even challenging the recent peak of the DXY, around the 110 mark, while investors would be seeking growth in US equities. The most complicated situation lies in the case of hard landing. Well, if the hard landing is caused by the bursting of the AI bubble, then both US dollar and US equities would likely be coming off, i.e. US unexceptionalism. But if we get a traditional recession, then there is a decent chance where the dollar would be going higher, i.e. the typical dollar smile theory coming back into play, while US equities suffer. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.